All right, let's get straight into this investment explainer on Asian paints. If you follow the Indian market, you already know this company is an absolute titan. But today, we're really looking under the hood. We're going to break down their financial year 2026 baseline performance, analyze the very real impact of some aggressive new competition, and then unpack their blockbuster Q1 results for FY27. It's a fascinating case study on how a legacy leader defends its castle against a billion-dollar invasion. Here is our roadmap for today. Number 1, a colorful legacy. Number 2, Q1 FY27 blockbuster results. Number 3, the competitive menace. Number 4, strategic moats and innovation. And finally, number 5, looking ahead to FY27. Let's start with section 1, a colorful legacy, foundation of a titan. We have to start with this number, 50%. Asian Paints holds an estimated 50% market share in India's organized paint market. To put that into perspective, they are practically 3 times larger than their closest competitor. And how do they maintain this iron grip? Well, it comes down to a staggering 170,000 retail touchpoints across the country. Think about that for a sec. 170,000 touchpoints is actually more widespread than many major national banking networks. It's over double the distribution reach of anyone else in the game. That kind of logistical stranglehold takes literally decades of groundwork, relationship building, and just immense capital to establish. Now, when we break that massive market share down into actual cash flow for their FY26 consolidated revenue, you can clearly see the decorative segment is the absolute heavyweight. It brought in over 30,000 crores, which is almost 87% of their total revenue. The international business sits at about 9.4%, and industrial paints, which they manage through strategic joint ventures, rounds things out at 3.8%. So decorative paint is the undisputed engine of this company, and it dictates exactly where they have to focus their defensive strategies moving forward. And you simply don't feed an engine of that size without world-class infrastructure. Take a look at this. This is their Khandala plant, which is just one piece of a massive footprint of 25 manufacturing units worldwide. As of FY26, they boast a staggering global manufacturing capacity of 2.3 billion liters. For any investor analyzing economic moats, physical scale like this is absolutely paramount. I mean, trying to replicate 2.3 billion liters of global capacity requires billions of dollars in upfront capital. It acts as a massive deterrent for challengers in what is fundamentally a highly capital-intensive industry. Moving right along to Section 2, Q1 FY27 blockbuster results. Explosive start to FY27. So comparing the first quarter of FY26 to FY27 reveals a massive acceleration. Just look at these numbers. Volume growth more than doubled, jumping from a modest 4.2% right up to a very healthy 9%. But the real star of the show here is the value growth. It skyrocketed from a negative 0.2% all the way up to 16.5% in just a single year. This incredibly sharp turnaround perfectly captures their successful push into premiumization and some highly calibrated pricing actions they took across their entire portfolio. So what does this volume and value growth actually mean for the bottom line? Well, it's pretty powerful. Consolidated net sales blew past the 10,000 crore mark, growing nearly 18%. And on top of that, their operating margin, the PBDIT margin, expanded by a massive 240 basis points to hit 20.6%. Plus, despite all the ongoing global uncertainties and supply chain disruptions we're seeing, their international business revenues surged by over 27%. For us investors, that 240 basis point margin expansion is the ultimate metric. It proves they've got the pricing power to pass on costs and prioritize profits, even when operating in a really complex macro environment. Okay. On to Section 3, the competitive menace, disrupting the oligopoly. Listen to this quote from a recent credit rating analysis. It says, "Competitive intensity has increased recently with the entry of new players, particularly a large one in FY25. This adds some vital, objective, third-party validity to the threat they are facing. Historically, the Indian paint industry has enjoyed extremely high entry barriers, right? But the landscape fundamentally shifted in FY25. We're now seeing immense pressure from highly well-capitalized new entrants. And these aren't just minor startups. We're talking about massive conglomerates willing to spend heavily and bleed cash on marketing and distribution, all just to carve out a slice of that 50% market share Asian Paints currently commands." So Asian Paints is essentially caught in a vice grip right now. On one side, you have these aggressive new entrants slashing prices to steal market share in the price-sensitive, non-luxury and economy segments. And then on the other side of that vice grip, you have volatile crude oil and raw material costs threatening to drive up their production expenses.
When you combine those two forces, it creates a very real threat to both their near-term volume growth and those beautiful 20+% margins we were just talking about.
Let's look at Section 4, Strategic Moats and Innovation, Defending the Castle. The management team hasn't been sitting still. They've laid out a highly structured battle plan to defend their margins and market share. It's essentially a six-pillar strategy for FY27, aimed at turning what could be a commodity market into an emotion-driven, service-heavy ecosystem. The six big areas are 1. Aggressive brand building, 2. Relentless product innovation, 3. Pushing premiumization, 4. Creating entirely new service moats, 5. Regionalizing specific products, and 6. Locking down their supply chain through B2B expansion and backward integration. It's a comprehensive wall of defense. And to prove they aren't just talking a big game about innovation, check this out. 17% of their FY26 revenue came entirely from new products. And by new, management strictly defines this as products launched within just the last 3 years. That translates to billions of rupees generated from brand new ideas. Honestly, that is phenomenal innovation intensity for a company that fundamentally just manufactures paint. It proves they are moving incredibly fast for a legacy giant. They are basically executing a pincer movement to defend their market share. At the entry level, they are deploying products like eco-emulsions. This brings world-first anti-damp technology down to economy prices, specifically designed to protect that highly competitive, price-sensitive segment from those new market entrants. Meanwhile, at the top end of the market, they are pushing the absolute limits of luxury with Emporio Urano, an Italian collaboration that promises unprecedented gloss and clarity. So they are effectively leaving no segment undefended. But it gets better. Beyond the paint itself, they're significantly expanding their moat by stepping away from just the wall and stepping right into the center of the room. Through their beautiful homes network, they're now providing customized furniture, fabrics, and lighting solutions. For an investor, this strategy is absolutely brilliant. By capturing the entire premium home decor lifecycle, they dramatically increase the lifetime value of a customer. Plus, they secure higher margin revenue streams that are immensely harder for new paint competitors to easily replicate. Finally, Section 5, Looking ahead to FY27, Locking in Loyalty. As we look to the immediate future, Asian Paints is relying heavily on aggressively scaling their end-to-end assurance-based services. First, they are expanding Beautiful Homes Painting, which they actually claim is the world's largest home painting service, driven by really high Net Promoter Scores. Second, for the commercial side, they offer Total Assure for builders, and third, Medicare, an anti-corrosion system for premium factories where they essentially warranty the entire facility. What's happening here is they are transforming from a simple product manufacturer into an indispensable integrated partner. Which brings us to the ultimate question for anyone analyzing this space. As the Indian paint oligopoly faces this unprecedented disruption, will Asian Paint's legendary 17,000 retail touchpoints, their massive brand equity, and these newly forged service moats be enough to weather the storm of well-funded competitors? It's a classic business battle, right? Legacy distribution versus new capital. And how this plays out will undoubtedly define the entire sector for the next decade. Thanks for joining me on this explainer today. I really hope this helped clarify the strategic landscape for you.